Good morning to everyone. May I request everyone to please take a seat and please keep your mobiles on a silent mode. With warm greetings, I, Dr. Dipali Dikshit, extend to each and everyone present with us my warmest welcome on behalf of SEBI and NISM, who has brought us together for the third SEBI NISM Research Conference. The world is full of diamonds and gems, and we are having some of them here today on the inaugural session of the third SEBI NISM Research Conference. I'm extremely privileged to welcome our whole-time member, SEBI, Shri S.K. Mohanty, and Director CKG Nair. Chairman SEBI, Mr. Ajay Tyagi, will be joining us shortly. Keynote address of the conference will be delivered by Shri Nikhil Rathi, Chief Executive, Financial Conduct Authority, UK. We thank you all of you for giving us your precious time. I'm also honored to welcome all researchers and other participants of the conference. Thank you all for joining us today. Let us begin today's auspicious event with the praise of the most merciful and the benevolent. I invite Dr. Nair and Mr. Sunil Kadam to please light lamp to express our gratitude towards the Almighty. Along with lighting of the lamp, I invite students of NISM, Vaishnavi, Hiran, and Shitika for Saraswati Vandana.
तुषारहारधवलम् या शुभ्रवस्त्रामृता या वीणावरदण्डमण्डितकरा या श्वेतपद्मासना या ब्रह्माच्युतशङ्करप्रभृतिभिः देवैः सदा वन्दिता सा मां पातु सरस्वती भगवती निःशेषजाड्यापहा।
Thank you. Thank you to students of NISM. The conference has adopted a very timely theme, investing in recovery, challenges and opportunities for the Indian securities market. We live in unprecedented times, facing a pandemic, which has transformed our lives, our economies, a journey that is reflected in the share prices as well. Some of the companies propelled at a record speed, while for others, headwinds have turned into hurricanes. Capital markets are powerful indicators of what could lie ahead, and this view puts the new realities we face into a stark relief. The ups and downs of the market, in a way, also reflects the confusion and the fundamental shifts triggered by a crisis. Yet, the past 2 years in the capital markets also tells us a story of resilience and hope, offering the promise of new growth on the other side of the long, dark COVID tunnel. We are going to discuss all these issues in the coming 2 days. Now, not taking much of your time, I invite Dr. Nair and Director NISM to deliver the opening address for the conference. A brief introduction of Mr. Nair. Before joining the Securities Appellate Tribunal in 2016, Dr. Nair was an officer of the Indian Economic Services for about 31 years and held various positions in Government of India, including the director positions in the commodity derivative markets, development policy, capital markets, advisor capital markets, Secretary FSLRC in the Ministry of Food and Consumer Affairs, Planning Commission, and Finance Ministry. He was involved in substantive policy law institutional reforms in the financial sectors in these capacities. These includes the report of the Financial Sector Legislative Reform Commission, bankruptcy law reforms leading to the enactment of the Insolvency and Bankruptcy Code 2016, reforming the commodity derivatives market regulation, culminating in the merger of the Forward Market Commission with Securities and Exchange Board of India. These are the few of his such reforms. Now I request Dr. Nair to please share a few words. Sir.
Thank you, Deepali, for those nice words. A very warm welcome to everybody, and very fine weather today morning. And I hope everybody is enjoying the NASM campus, those who are staying here. And others, of course, are enjoying the weather in Padalganga, which is nice these days. It's indeed a privilege to co-host this conference, which consists of so many luminaries as well as intellectual contributors in the field of the financial markets, particularly in the securities markets. We have with us Mr. Mohanty, and I has Chairman joined? Yeah. Anyway, Mr. Mohanty, Mr. Ajay Tyagi, Chairman, who would be joining anytime now. Mr. Nikhil Rathi, the CEO of the Financial Conduct Authority of the UK, and all participants. Mr. Sunil Kadam, Registrar of NASM, who is on stage. And I am really honored to be here and speak a few words, apart from recognizing the contribution made by a lot of you in making this event a successful one. These are exciting times for the financial markets. Why I say exciting times? Because so many developments are happening simultaneously, though we are in the grip of a pandemic. There is an excess of liquidity. There is the highly dynamic developments in the fintech area, which has married the financial sector like anything, and the pandemic going on, which make the situation like a perfect storm. And in this perfect storm, what happens is that traditionally research used to be a lazy, laid-back type of effort. But even those lazy, laid-back type of researchers in the conventional sense, of course, I am not putting it in a negative way. In fact, if research has to be done in a very relaxed manner, a rapid and waterfall type of research may result in unexpected results, which may not be what we are looking for. But what I am telling is that financial market research, even in normal times, is not an easy task, because capturing the mind of the market is not easy. And as you all know, Adam Smith called this the invisible hand. But nowadays, I have a feeling that the invisible hands have got very highly visible eyes and very far-reaching eyes. What I am telling is that if you look at the events which is happening around us, events which are happening around us, you can see that today the market has gone down on the expectation that Russia is going to attack Ukraine. And tonight, Russia actually has done something more, may not be a full-fledged attack. In fact, some degree of attack has taken place. But tomorrow the market is booming. So I am not able to understand how the market factors in this sort of situation. So that's why I would say that the traditional style of research using the backward-looking approach, means using the past data, it has never been relevant for the financial markets. But of course, we do use that. So I have a question: why do we continue to use the past data for predicting future events or events which are likely to happen the next moment? Future in financial markets means the next moment as well. It's a long run. There is a second is a long run in the financial market. So all those definitions of the economists who used to do research in a lazy manner are gone. All assumptions of rationality is gone. And in place of rational investors, we have these days adventurous investors, and who are not investing in traditional assets. There are innovations happening on the frontiers of the regulatory space. So many of the investors, including some of the retail, we define retail investors in terms of the size of the investment, where one of the primary market experts, Mr. Haldia, raises a question that if he invests in 100 IPOs all at less than 2 lakh rupees, does he or she become a small investor? So in a particular year, 2 crore has been put on IPOs. So these sort of issues are there, and we need to find answers for these things. But financial market itself is trying to find out some answers in terms of shifting its focus on research. These days, artificial intelligence is trying to capture the next moment and the future events in terms of scattered information available in the online space. Like you unleash a very powerful ego, powerfully algo. Yeah, of course, sorry for that. Many times the algos, the developers of algos also have a powerful ego. That's why you got it mixed up. So you unleash a powerful algo and try to get the information which can happen in the near future, and it can factor in even a collision between two stars or the possibility of a meteor attacking the Earth. We don't know what all the algos will capture once you unleash an algo in terms of locating this information. So we should be ready to face the financial market analytics in terms of these tools, in terms of developing artificial intelligence-based tools in capturing what all relevant things are actually getting into the prices or the volatility or the ups and downs of particular sectors. Definitely, these are not in terms of the traditional fundamental analysis or even the technical analysis. Things are moving much faster than all those things. Now, I am sure some of the themes which will be presented as papers in this conference will unveil the secrets and the mysteries behind some of these developments. And let me also come to the formal part of it. We have received about 149 papers, out of which 33 papers have been identified for presentation. I congratulate all the people who have contributed the papers, as well as a special congratulations to everybody whose presentation is being scheduled. And this conference is the effort of a large number of people. Some of them are visible here, some of them are not here, but who stood at the background in terms of external reviewers, who are about 100 academicians, regulatory leaders, and market participants through a blind review process. And I gratefully acknowledge their contribution in this. And as another feature of this conference is the participation from several foreign countries like Australia, France, China, United States, New Zealand, Denmark, and Saudi Arabia, and also from several institutions of excellence like IIMs and IITs, XLRI, Madras School of Economics, many central universities. I am not calling out each one of their name because they are very large in number. I also extend my congratulations and regards to all of them in doing so. And also the theme, as I stated in my introductory, a few words of introduction, the topics which have been covered in this conference also are very, very diverse. Maybe on the one end, you can say the dynamic volatility connectedness of major ESG stock indices. So that is one of the latest areas where which is important in the financial market. And also to the other extent of political connections, fame, leverage, and cost of capital. So bringing in a lot of socio-political and behavioral issues into question. And I also congratulate all those people who have spent a lot of time and energy in preparing papers on these frontier areas, which will address some of the concerns which I raised at the beginning. And then there are a lot of people who are going to chair and do their task as discussants in this conference. I acknowledge their potential contribution, which you will all see, and also for taking the time out for doing their task, assigned task. And in addition, a lot of people had been jury members in identifying the papers, which are, as I told you, a large number of papers, and which have been gone through thoroughly. And I am very grateful for them, like Dr. Sethu, Professor Bhanamurthy of the Vice Chancellor of Vaisi University, Bangalore, Dr. Partha Ray, Director NIBM, Professor Malabiga Dio, Professor in Pondicherry University, Professor G.C. Nath, and Dr. Dinesh Panchali. And similarly, this event would not have been possible but for the untiring efforts made by two sets of people, one from SEBI and another from NASM. From SEBI, I would particularly like to take the name of Mr. Amarjit Singh, Ms. Dibali, Dr. Dibali Dikshit, who is here, Mr. Garg, and a lot of their team members who are large in number. So I am not taking this time to mention their name. If anybody's name is not omitted, only I am responsible for that. Similarly, from NASM side, Dr. Lada Chari, Dr. Jadin Trivedi, Dr. Padipati Panda, and their team members, a large number of them. And in fact, everybody from NASM has contributed to make this event a grand success. And then in addition, I would also like to acknowledge the editors of 4 journals of repute who have agreed to publish the papers which are being presented in this conference. And last but not least, I would like to thank all those who are participating in this conference in any capacity, and from anywhere in this auditorium or from anywhere in India or abroad. And once again, thanking you all. And once again stating, if I missed everybody by name, I am only responsible. Sorry for that. And wishing you all the best. I look forward to the deliberations in the both in the panel discussions as well as in the technical sessions, apart from the inaugural sessions, which are very pithy themes will be unfolded in the speeches by Mr. Mohanty and Mr. Tyagi and Mr. Dati, which is to follow. Thank you very much.
Thank you so much, sir, for sharing your thoughts with us today. I consider it a great honor to invite our whole-time member, Shri Santosh Kumar Mohanty, to deliver the theme address of the conference. Shri Mohanty is an IRS officer of 1991 batch and is presently posted as a whole-time member SEBI in Mumbai since June 2018. Prior to taking charge as a whole-time member, Shri Mohanty held the position of Executive Director SEBI on deputation since September 2015. As a whole-time member of SEBI, Shri Mohanty is now looking after the departments dealing with primary markets, surveillance, corporation finance, investigation, commodity derivatives market regulation department, Department of Economic and Policy Analysis, and Information Technology Department. He has chaired a committee set up by the government to recommend warehousing norms for non-agricultural commodities. He also served as a member of High-Powered Integration Committee constituted by the government for recommending on integration of spot and derivatives market in India. I request Shri Mohanty, sir, to please share a few words with us.
Thank you, Dipali. Dr. CKG Nair, Mr. Sunil Kadam, who are present right now. Very shortly, Chairman SEBI, Mr. Tyagi will join us. And also, I think Mr. Nikhil Rathi also will join us for his talk. and all the eminent faculty members, research scholars, and those participants who have taken time to attend this inaugural session and also have decided to attend the two-day seminar. On behalf of SEBI, I extend my warm welcome to all of you. A very good morning to all of you. So I find year on year, this conference is definitely assuming its size as well as in terms of participants, number of participants, quality of themes, topics being covered. And every year it is getting more and more interesting. This year also it is going to be interesting, definitely. I can see the topics that we are going to discuss through our panel discussions, as well as the topics that are going to be presented by the research scholars. And as a regulator, we'll definitely look forward to new ideas, new thought processes, which definitely will help us in our policy making in the long run. My purpose here amongst you is just to give a glimpse of the theme that we are going to cover. As all of you know, since the pandemic began, the dynamics of capital markets worldwide are undergoing further changes. In the wake of the pandemic, several interrelated forces are transforming the way global capital markets work. They are expected to play a progressively more important role in providing access to capital. Over the last 2 years, the Indian stock market attracted domestic as well as foreign money with the help of liquidity, supported by the global central banks, coupled with supportive domestic policies and the world's largest vaccination drive that we had in India, which helped Indian economy to bounce back. The ongoing pandemic presented us with both opportunities and challenges. Thus, the third SEBI NISM Research Conference that we are having today has aptly chosen the theme of this seminar conference as Investing in Recovery, Challenges and Opportunities for Indian Securities Market. Next 2 days in the conference, there will be a lot of discussion on these issues. Let me discuss about some of these briefly. Let me first touch upon some trends that we have observed in Indian economy during our recovery phase. India has become amongst the world's fastest growing startup ecosystem with over 80 unicorn startups at the end of 2021. In 2021 itself, India overtook the UK as the third largest ecosystem for startups with 44 unicorns. The year 2021 itself again recorded 44 PE-backed IPOs getting listed, which is the highest ever. The e-commerce and technology attracted most investments of $15 billion and $14.3 billion respectively. The emergence of new models in fintech, consumer internet, education, enterprise technology, and media and entertainment have revitalized funding in these sectors. There was an increase in private equity and venture capital investment in this segment too. According to the Indian Venture Capital and Alternate Capital Association E&Y report, PE VC investments in startups emerged as the top investment segment in 2021, recording almost $29 billion and accounting for 37% of all PE VC investment in 2021. Now moving on to our investors, with market data readily accessible and new technologies assisting and significantly reducing the cost of trading, it has never been that easy and cost effective for the retail investors to participate in the security market as it has been in the last 2 years. Also, our increasing importance of mutual funds, introduction of new types of products, and a strong performance of securities market in the recent times have played its role in increasing retail participation in securities markets. This is prompting the regulators to review the functioning of the securities markets to provide better conditions for financing innovations, investment, and growth. The challenge for the market infrastructure institutions, MIIs, which we call, is to adapt to the changing landscape, competing yet collaborating with one another. For companies, the need is to have credible exchanges for public listing, as well as a range of private funding options, which need to continue to expand, offering ever more alternatives when they seek to raise capital. Not only the MIIs, regulator is also working towards providing a facilitating framework for use of technology to simplify the process of KYC procedure in the securities market. SEBI has recently enabled online app-based KYC procedure, which has helped tremendously retail investors to open their Demat trading account sitting at home even during the lockdown. Recently, SEBI has launched an app called Sarathi, which aims to create awareness amongst the investors about the basic concepts of securities market, KYC process, trading and settlement, mutual funds, recent market developments, investor grievance redressal mechanism, etc. This app is expected to empower investors with knowledge about the securities market. With increased access to markets for all segments of a society, there is also a need for more refined products. One such development in this respect is the proposed gold spot exchange, wherein gold will be traded in the form of electronic gold receipts, providing investors with another gold product to diversify their portfolio. Along with diversification, there is also a need to design products aiming towards overall development of the society. In recent times, sustainable development and climate change are two most important issues around the world. Importance of sustainability issues and the risks these issues pose for the investors and the society at large is very well demonstrated by the present pandemic that we are facing today in this world. There is a transition towards sustainable economic models around the world. Securities market play an important role in this transition. UNCTAD estimates that the value of sustainability-themed investment products in global capital markets amounted to $3.2 trillion in 2020, which is more than 80% from 2019. In this 2 days conference, we hope to get new insights from the researchers on this very important aspect. Further, for overall development of the society, it is also critical to develop ingenious methods to ensure a smooth capital flow to the social sector and its effective utilization. Development of social stock exchange is one such step in the right direction, which can serve as a potential funding mechanism for non-profit organizations and for-profit social enterprises as well. We have already taken a step forward in this direction. There is also a need to create necessary investment ecosystem for enterprises and investors with an objective to generate maximum positive social impact and place environmental, social, and governance features into the overall objectives of these enterprises. All these are positive developments, but not without risks. The present scenario raises important questions about market and institutional resilience and investor safeguards. It also requires continuous review of the products and services available in the market and also reviewing the relationship between the various stakeholders in this market. The possible increase in policy rate may create short-term liquidity pressure in the capital market worldwide. Prices of all major commodities increased after bouncing back in demand from the pandemic. The world already witnessed energy crisis as supply of natural gas, coal, and other energy sources fail to adequately satisfy growing demand. Increase in commodity prices may impact the profitability of the manufacturing companies as well. As the world's economies rebound, there is a need to rebuild or build resilience and to remain competitive in the face of the innovation. The present pandemic situation has compelled reflection and accelerated change. There is a need to evolve in an inclusive and collaborative manner with all the other sectors of the economy. All these aspects will be discussed in this 2 days conference, and we expect some good research inputs for further development on those concepts. With this, I'm wishing all the participants, all the panel speakers, and all the judges as well, all the best. And we are looking forward to have very enriching and definitely very good interactive 2 day seminar conference, which will be definitely give a lot of productive takeaways both to the regulator, to the research scholars, and all the participants. Thank you.
Thank you, sir. We are so honored and privileged to have you amongst us. The next distinguished to honor us with his presence is Chairman SEBI, Shri Ajay Tyagi. Shri Tyagi assumed office as Chairman of Securities and Exchange Board of India with effect from March 1st, 2017. In a career spanning over 32 years, Shri Tyagi, a former Indian Administrative Service officer, has held several responsible positions with distinction in the state and central governments. Prior to assuming office as Chairman SEBI, Shri Tyagi has served as Additional Secretary in the Department of Economic Affairs, Ministry of Finance, handling diverse areas like capital markets, investment, infrastructure financing, financial sector reforms, financial stability issues, and coins and currency. Earlier, he served as a joint secretary in the Ministries of Environment and Forest and Petroleum and Natural Gas. He also served as secretary of the Petroleum and Natural Gas Regulatory Board. In the government of Himachal Pradesh, he has served as a principal secretary in the departments of Finance, Planning, Industries, and Information Technology. May I request Chairman Sir to please share his thoughts?
Good morning, ladies and gentlemen. It is my pleasure to address this inaugural session of third SEBI NISM Research Conference. The theme of the conference, that is investing in recovery, challenges and opportunities for Indian securities markets, is very relevant in the present times. It is heartening that the conference offers a lineup of excellent research papers and panel discussions with eminent speakers from India and abroad. In March 2020, India, along with the rest of the world, was catapulted into an unprecedented crisis with the outbreak of coronavirus. What started as a health crisis in hardly any time evolved into a devastating social and economic crisis, bringing businesses and economies to almost a standstill. Lockdowns, supply chain disruptions, and loss of business led to layoffs and acute financial distress to the masses. India adopted the path of Atmanirbhar Bharat, focusing on increasing investment in sectors of strategic importance so as to revive the economy. Naturally, capital markets had a critical role to play in facilitating such investments. At this time, let's take a few minutes to recapitulate the developments in the capital market since the onset of the pandemic. Nifty plunged to 7,511 on March 24, 2020 due to the concerns and panic of the investors, both foreign and domestic. It was in line with the global trend. The markets recovered in the backdrop of stimulus measures announced by the governments around the globe and ultra-loose monetary policy of central banks. Quick market recovery offered financial cushion to large number of investors whose investments were hit by the economic downturn. We have come a long way since then. In fact, Nifty touched its all-time high of 18,604 on 19th October 2021. In line with the trend of the broad market indices, average daily turnover in the equity market increased from 39,108 crore rupees in financial year 2020, that is 2019-2020, to rupees 66,036 crore in 2021 and 73,179 crore in this financial year till January end. This is an increase of 87% over the last 2 years. A large number of new investors entered the market during this time. As compared to financial year 2019-20, in which around 80 lakh new Demat accounts were opened, about 1.58 crore accounts were opened in financial year 2021. The 10-month period of financial year 21-22 ending 31st January 2022 witnessed opening of approximately 3 crore new Demat accounts, which is about 4 times the count in financial year 2019-20. Investment in mutual fund schemes also witnessed a surge. The number of mutual fund investors based on unique PANs as on March 31st, 2020 and 2021 was 2.03 crore and 2.23 crore respectively. The number stands at 3.12 crore as on January 31st, 2022. The total assets under management of mutual funds increased from 22.3 lakh crore as on 31st March 2020 to 31.5 lakh crore as on 31st March 2021 to 38 lakh crore on 31st January 2022. Now coming to some of the policy changes in recent times. COVID-19 not only led to business shutdowns and job losses, but also increased the cost of goods and services. Restoring normalcy not only required increasing the access of businesses to raw materials, but also finding alternatives to resources that are normally taken for granted. Innovative solutions backed by technology played a key role in addressing these challenges. For example, the social cost of lost educational opportunities would have been catastrophic for a country like India in the absence of online teaching platforms. Access to capital at reasonable cost in a timely manner is critical to address economic downturn. Such capital is required not only by existing businesses, but also by potential entrepreneurs. Naturally, the perceived risk of investing in an untested entrepreneur is far higher than that of investing in established business, especially in an environment of unprecedented uncertainty. Further, existing companies in financial distress found it difficult to raise funds, whether from banks or from the market. In the wake of pandemic, the government as well as the regulators acted proactively and introduced various measures to stimulate economy and support growth. SEBI came out with a number of relaxations to facilitate fundraising by the corporates. Some of the policy measures for equity markets include dilution of lock-in requirements in public issues, shorter timelines for rights issues, dematerialization and trading of right entitlement in stock exchanges, relaxation to minimum public offer requirements for issuers with post-issue market capitalization beyond 1 lakh crore. On the other hand, debt markets benefited from reforms such as the removal of track record as a criteria for accessing the bond market, removal of limit on the number of issues through shelf prospectus, introduction of electronic bidding platform and request for quote platform for improving transparency, reducing timelines for listing of privately placed debt securities, etc. Impact of these policy measures is reflected in the fundraising data. Indian securities markets witnessed fundraising of nearly rupees 10 lakh crore in both financial years 2019-20 and 2021. Through public issues, rights issues, and private placement, security capital worth 3.06 lakh crore, rupees 2.29 lakh crore respectively was raised in financial year 2019-20 and 2021. In this financial year, the total equity capital raised through the securities market till end of January is 2.17 lakh crore. The main board witnessed 49 public issues and 31 rights issues, while the SME segments of stock exchanges brought in 53 public issues and 2 rights issues for a total of 1.31 lakh crore. Another 86,000 crore rupees was raised through private placements. Corporates raised debt worth 6.9 lakh crore and 7.8 lakh crore rupees respectively through capital market in financial year 1920 and 2021. This year till end of January 2022, rupees 4.7 lakh crore have been raised to the corporate debt market. Not every company or promoter is positioned to easily raise funds by accessing the public markets, though their needs may be no less genuine or critical than those who access the public markets. As per the information published by DPIIT, India is home to more than 60,000 recognized startups. These startups are expected to not only generate employment, but also to advance the country through technology revolution. Some of the areas identified by the government where startups can have immense impact include artificial intelligence, geospatial systems and drones, green energy, clean mobility systems, etc. The traditional sources of capital raising, such as bank loans, are not easily accessible to these startups as they are often asset light and therefore unable to provide sufficient collateral, as is typical for bank loans. Very often, timely availability of capital at reasonable cost is one of the most critical factors in the success story of a startup. SEBI registered AIFs have played a significant role as providers of capital to such startups. As on 31st December 2021, there were 824 AIFs registered with SEBI with a total capital commitment of rupees 6.09 lakh crore, investment worth 2.67 lakh crore. The increasing popularity of AIFs as investment vehicle is evident from the fact that 11 months of financial year 21-22 saw 125 new AIFs being registered as compared to 90 AIFs during the whole last financial year. Despite the ongoing concerns of COVID-19 pandemic, the industry raised commitments worth 81,000 crore rupees in financial year 2021 and a further 1.58 lakh crore in the current financial year till December quarter. Venture capital funds is a subcategory of category 1 AIFs, which are set up to invest primarily in unlisted securities of startups, emerging or early stage venture capital undertakings, numbered 145 as on 31st December 2021, and have together invested over 14,000 crore in our economy. To facilitate greater amounts of investments by AIFs in startups, one of the recent measures taken by SEBI was to align the definition of startups under the AIF regulatory framework with that specified by DPIIT. The distress in economy in the aftermath of pandemic has touched more than just startups and businesses seeking public funding. Bad loans have been a burden on the formal banking system for some years now. While the country is charting out a plan of economic recovery, it is imperative that the capital of banks and NBFCs locked in stressed loans be released and made available for lending to the desired sectors. To aid in this endeavor, SEBI recently introduced the framework of a new subcategory of AIFs, termed as special situation funds, which are permitted to buy stressed loans from banks and NBFCs. The regulatory framework for special situation funds has been developed keeping in mind the unique challenges faced by such funds in restructuring on or turning around businesses. Traditionally, the market's focus is on businesses and entrepreneurs who raise funds for commercial purposes. However, there are a number of NGOs, philanthropists, social enterprises, etc., which work towards the social welfare of the underserved or less privileged population. A reliable, transparent platform for raising funds for projects aimed at social welfare can go a long way in helping these stakeholders. The proposed social stock exchange, a platform for listing social enterprises and voluntary organizations so that they can raise capital, is a step in this direction. The broad framework for introducing social stock exchange as a separate segment under the existing stock exchanges has been recently approved by SEBI board. We are in the process of notifying the detailed modalities in this regard. Now, coming to the challenges, while a lot has been done, the journey to economic recovery remains riddled with challenges. Let's take a look at some of the key challenges for the capital markets. To begin with, we are witnessing increasing trend of new age tech companies accessing public markets. In the current financial year, such companies through IPOs have raised approximately 43,283 crore till date. Out of these, no less than 85% of the issuer companies were backed by private equity investors, and of such issues who had an offer for sale component. Appropriateness of valuation of these companies is a matter of intense debate amongst stakeholders these days. At the time of accessing the capital markets, these companies are generally loss-making as they prefer gaining scale over profits in growth phase. The traditional parameters required to be disclosed in offer document, that is the financial ratios, are typically descriptive of profit-making companies. Globally, valuation of such companies is generally determined on the basis of additional factors, that is trends in key performance indicators and their comparison with peers, valuation at earlier funding rounds, market conditions, etc. Disclosure of additional parameters will aid investors in making investment decisions in these category of companies. SEBI has come out with a consultation paper on strengthening the disclosure requirements in offer documents so as to ensure that rationale adopted by issuers for valuation and transparency is transparently known to market and investors, and investors are able to take more informed investment decisions. Research on identifying material key performance indicators and developing valuation model for such companies could be very useful. Next is the flourishing landscape of ESG investments. According to Bloomberg, global issuance of all sustainable debt in the calendar year 2021 was over $1.6 trillion, more than double the previous year's figures of $763 billion. In India, mutual funds have been launching equity schemes in the ESG space under thematic category. The mutual funds are also launching exchange traded funds and ETF fund of funds in ESG space. As on 31st January 2022, there were 10 mutual fund schemes in India having ESG as their theme, with assets under management of over 12,000 crore rupees. In the last 5 years, under the framework for issuance of green debt securities, 10 issues have together mobilized about 3,100 crore rupees for exclusively financing projects in the areas such as renewable and sustainable energy, low carbon transport modes, sustainable land use, etc. Academia would tell us that environment, social governance norms are meant to guide stakeholders in economic activity to adopt practices and policies that are intended to create long-term sustainable benefits to all stakeholders. However, universally accepted metrics for ESG norms is still a work in progress. Despite the absence of uniform ESG evaluation matrices, vast amounts of funds are being raised by professional fund managers and corporates to invest in projects and initiatives that purportedly are ESG compliant. In the listed space, SEBI has attempted to provide a uniform standard for disclosures that have a bearing on ESG evaluation by prescribing business responsibility and sustainability report, that is BRSR. In May 2021, BRSR requires listed companies to make disclosures related to 9 principles covering both environment and social aspects, such as climate action, responsible consumption and production, gender equality, working conditions, etc. BRSR is applicable to top 1,000 listed entities by capitalization for reporting on a voluntary basis for the current financial year and on mandatory basis from next year onwards. This is with a view that investors in listed companies have some means to assess ESG risks and opportunities for these companies. Then we come to ESG rating providers and data providers. As of now, ESG rating space in India is unregulated. The rating methodologies are often not transparent. For the ESG ratings, the scores of a company may vary significantly across different rating providers, as rating providers are using varied evaluation matrices. Considering the significance of ESG ratings in the investment ecosystem, SEBI has recently come out with a consultation paper on ESG rating providers. SEBI will take a view in this regard after evaluating all stakeholders' inputs. That said, a lot more work is required before we can put in place a comprehensive framework that deals with all aspects of ESG and related issues. The innovators growth platform of stock exchanges provide the means for listing of issuers which are intensive in the use of technology, information technology, intellectual property, data analytics, biotechnology, or nanotechnology to provide products, services, or business platforms with substantial value addition. It is expected that IGP would provide ready liquidity, secondary market exits, and value unlocking for the investors. Considering the growing number of startups and the growth conducive environment being created for them by both the government and regulators, SEBI has recently introduced certain reforms in the innovators growth platform framework with a view to revitalize the platform. The SME segment is also another space which has great potential, but not utilized to the expected level. A better understanding of the requirements and challenges faced by investors and the issuer companies may help to reform these platforms to reach their true potential. Now, coming to a conclusion, while many economies around the globe continue to reel under the aftershocks of COVID, India's journey of economic recovery is a testament of the timely and well-coordinated efforts of the government and regulators, ably supported by the relentless spirit of our citizens. Market infrastructure institutions and intermediaries ensured that the capital market performed at no less level than its best during the turbulent times. That said, the journey of economic recovery is challenging. Keen minds and sharp intellect directed towards identifying the problems in the system and developing solutions to address the same are the need of the hour. I have only enumerated a few of the challenges faced by our market. There are so many more. No doubt, many of the research papers being discussed in this conference would bring out valuable inputs for SEBI and the market participants. I hope that this research conference encourages more and more of our scholars to direct their research potential towards issues relevant to the growth of our economy and particularly the securities market. I wish the participants all the very best. Thank you.
Thank you, sir. It will be a great pleasure for us to listen to you again in our future events. Now, I consider it a great honor to listen to Mr. Rathi, Chief Executive, Financial Conduct Authority, UK, who has graciously consented to be a keynote speaker today. Shri Rathi began his career in HM Treasury before serving as Private Secretary to the Prime Minister between 2005 to 2008. Shri Nikhil then became head of the Financial Stability Unit, overseeing a number of the UK's financial stability interventions before becoming HM's Treasury's Director of the Financial Services Group from 2009 to 2014. In that role, he also served as the UK representative to the European Union Financial Services Committee. Shri Nikhil joined the London Stock Exchange in 2014 and was appointed CEO in 2015. It will be a great honor to listen to him. Over to you, Rajveer.
Good morning. Director Nair, Chairman Tyagi, thank you for the kind invitation to address SEBI and NISM's research conference. It's an honor to speak to you today. I hope to offer a few thoughts on how our two countries and authorities can work together to support a sustainable economic recovery from the pandemic. We are meeting at a very exciting time for UK-India relations, with great opportunities for cooperation, policy exchange, trade and investment between our two countries. The 2030 vision, launched by PM Modi and PM Johnson last year, set out ambitions to deepen the bonds between our countries across all areas of society. In January, our governments launched negotiations on an ambitious free trade agreement. Investment from Indian companies already supports 95,000 jobs across the UK, while UK companies in India employ over 416,000 people. Such a deal could create huge opportunities for both countries, with the potential to boost trade by up to £28 billion a year by 2035. Within financial services, there is clear ambition to bring our markets closer together. There are already important connections. For example, over the last 5 years, Indian firms have raised £13 billion in masala dollar and green bonds on the UK market. Greater collaboration between our governments and regulatory authorities can enhance cross-border investment and ensure our markets are delivering for the public safely. The relationship between the FCA and SEBI will be vital as negotiations continue to ensure the agreement meets both economic and regulatory objectives. Regulators have a critical role to play in supporting the economic recovery. We need to ensure our regulatory framework enables productive investment, protects consumers, and is agile to new risks. With financial markets being increasingly global, cooperation between authorities across borders is critical to delivering on our domestic objectives. UK-India financial cooperation is at a high point. Sustainable finance, innovation, and the establishment of Gift City Financial Centre have been key areas of collaboration, with the potential for even stronger joint work ahead of India's presidency of the G20 later this year. I also want to take this opportunity to thank our Indian counterparts for their responsiveness at the start of the pandemic crisis. As our nations went into lockdown, SEBI ensured key financial services workers in India, including those fulfilling key functions for UK firms, could continue their vital work and meet local COVID-19 rules. This was essential in ensuring that UK firms could continue to meet the needs of their customers. I'm now going to talk about some of the opportunities for our countries where international regulatory cooperation can make a real difference, as well as some of the challenges. Whether it's capital market reform or digital innovation, crypto assets or net zero targets, we can't achieve the best outcomes in isolation. It is clear markets and investors are adapting in response to the pandemic. Regulators need to work with these changes to ensure sustainable and safe recovery and growth. Both India and the UK have seen significant increases in the scale of equity capital raising coming out of the pandemic. In India, 63 companies collectively raised 1.2 lakh crore, $15.4 billion through IPOs in 2021. In the UK, over 120 new companies raised £16.8 billion, or almost 1.71 lakh crore, the strongest year for capital raising by IPOs since 2007. To continue to maintain increased use of public markets, regulation needs to be dynamic and responsive. In the UK, we're working on capital markets reform to ensure we remain open and connected globally. The UK is designing its post-Brexit regulatory framework, an opportunity to adapt our system to tailor our rules to UK markets. We have introduced new listing rules, changes to free float, special purpose acquisition company listing rules, and dual class share structures to support public capital raising, and are looking at wider reforms. Turning to investment funds, a crucial part of the ecosystem, we need to ensure that the benefits and risks of these vehicles are understood and managed to support long-term recovery and growth. It has been encouraging to see the growth of mutual funds in India, supported by SEBI's leadership. The 41% increase in assets under management in these funds, from 22.3 trillion Indian rupees to 31.4 trillion during 2021, reflects the growing importance of this sector for Indian investors. An increasingly important part of the funds landscape is passive investing. In the UK, around 31% of funds are passively managed. Within India, some estimates suggest that passively managed funds could grow by 8 times by 2025 to around 40% of the overall funds landscape. I am sure this rapid growth will be an important discussion at the conference today, and what this means for Indian investors and markets, as it was when the FCA and SEBI held a joint conference in 2019. Then as now, passive funds have clear benefits for retail investors: lower costs, easier diversification, and their presence can pressure active funds to work harder and review their fees. But there are important questions about the impact their rise has on market efficiency and effectiveness, and especially in the context of ESG, investor engagement and stewardship. In the UK, following our asset management market study and reviews of the Stewardship Code, we introduced reforms to improve the transparency of both prices and fund managers' use of voting rights. Infrastructure and real estate investment are a vital part of recovery. Like Indian authorities, we also want to support longer-term infrastructure investment. The Indian government and SEBI's progressive reforms of REITs and InvITs in recent years have enabled the growth of this asset class and supported India's growth and productive capacity, with nearly 76,000 crore of funds raised since the pandemic began. In October, we finalised rules in the UK for a new long-term assets fund, designed to support investment in long-term assets such as infrastructure and private equity. Our new rules embed longer redemption periods, high levels of disclosure, and strong liquidity management and governance features, providing sufficient investor protection and enabling more sufficient and sustainable long-term investment. LTAFs can support not only UK projects, but also projects overseas. They pool a wide range of UK and international investors, and later this year we will consult on expanding retail participation. As two leading technology-driven countries, the UK and India have a lot of experience to share on financial innovation. It was great to see Indian authorities, such as Gift City's IFSCA, join our sustainability tech sprint last year, and several Indian authorities are joining the Global Financial Innovation Network. We welcome participation in this network from Indian colleagues, and we want to make the most of these chances to work together. Innovation also brings challenges. One of the most salient right now is crypto assets. The number of crypto investors is growing all over the world. Our research suggests that over 2.3 million adults in the UK now hold crypto assets. Some estimates suggest India may have one of the largest adoption rates globally. And while adoption rates are difficult to measure, it can be even less clear how many people fully understand what they're investing in. We know that the technology crypto assets are built on has potential, and we will continue to support the beneficial uses of distributed ledger technology. But the key part of our job is to make crypto safer. There is a live debate in many major financial jurisdictions about whether regulators need more powers and tools and clarity of remit to regulate crypto. We can see clear risks to consumers, but at the moment our powers are largely around money laundering. Exchanges can be used to launder the proceeds of crime, and we must contribute to the global efforts to address financial crime by demanding that businesses with the UK presence meet the necessary standards. This remit has allowed us to challenge crypto asset trading platforms through our authorizations process, and we found that lots of them don't meet our standards. Our colleagues in the US, the SEC, have also taken a range of recent actions. But we have limited tools to protect consumers. We banned the most harmful retail products referenced in crypto assets, crypto derivatives. But there is a huge range of unregulated products, and we're concerned about the risks to consumers using them as speculative investments. We're consulting on new, stronger rules on financial promotions, and we've also launched a campaign to help inform consumers about these risks. We know that you have concerns about crypto too, and that there is a debate about whether crypto assets should be banned. International coordination between regulators will be important as we plan the best way forward. We all have similar goals to prevent financial crime, protect consumers in the financial system, while harnessing innovation. The biggest challenge of our time is climate change. Our recovery needs to be green and sustainable, and financial services need to support these national and international efforts. The UK welcomed Prime Minister Modi's commitment to net zero by 2070 at COP26, and the summit acknowledged the scale of the challenge in raising green finance. We are eager to work with SEBI to achieve these goals. On some estimates, we need collective public-private investment of $100 to $150 trillion globally through to 2050 to keep emissions in check and achieve the 1.5 degrees temperature goal. Public finance will of course have a role to play. The launch of India's first rupee-denominated sovereign green bond last month was an important milestone, as was the UK's first green gilt in September 2021, launched to an enthusiastic reception by investors. But climate-oriented private financing needs to increase dramatically. There is clear investor demand. Bloomberg has predicted that responsible and sustainable financial products will account for fully 1/3 of global assets under management by 2025. In the UK, responsible investment funds accounted for almost 40% of net UK retail fund sales in 2020, and we have watched with interest the growing expansion of ESG funds in India. However, corporates still have too much discretion on how and what they report, impacting the quality of ESG investments and opening risks to greenwashing. To improve the quality of climate and ESG investment, we need to improve corporate reporting and disclosure. Both the FCA and SEBI have recognised the need for improvement through the new Business Responsibility and Sustainability Report in India and our TCFD-aligned disclosure rules. We certainly can't achieve our ESG objectives in isolation. It has been very encouraging to see the policy challenges and lessons learned from our respective approaches being shared through the India-UK Sustainable Finance Forum and bilaterally between our two authorities. We also need to work globally and drive towards consistency to enable cross-border investment and reduce regulatory arbitrage. Establishing common global standards and building collaboration to promote progress across jurisdictions is key. Through our role as co-chair of IOSCO's workstream on sustainability reporting, we supported the establishment of the International Sustainability Standards Board, launched at COP26 last year. The board is a game changer, creating for the first time a common baseline of reporting standards on sustainability, integrated with financial reporting, which can be adopted around the world and supplemented as appropriate, with jurisdiction-specific requirements. All the major jurisdictions are now on board, and we look forward to working closely with Indian authorities as the first set of rules are developed and rolled out. I'd like to close by emphasising the importance of working together to find solutions underpinned by international standards as we address the forces transforming our sector. The key challenges we face, recovering from the pandemic, harnessing new technology, tackling climate change, simply cannot be tackled in isolation. I wish you a thought-provoking and productive conference and look forward to continuing to work with you in the coming months and years. Thank you.
We thank Mr. Rathi for sharing his thoughts with us. Taking this opportunity, we would like to invite Mr. Nair and Mr. Sunil Kadam to release the conference compendiums for the second SEBI NISM Research Conference and the second Annual Capital Market Conference, and also the student magazine review. Now I invite Mr. Sunil Kadam, Registrar NISM, to deliver the vote of thanks.
Good morning, everybody. Yes. Research in securities market plays a very important role, and these conferences are being organized keeping in mind to promote the research in securities market, which will help us to make policy decisions as well as the overall development of securities market. And keeping this in mind, SEBI and NISM has been conducting this conference for the last 2 years, and this is the third conference which we are doing. For these inaugural sessions, we had Mr. Nikhil Rathi, who has given us an overview of India, UK business activities or financial activities, and also the opportunities for developing the India-UK tie-ups. And I'm sure this speech and his thoughts would give a lot of opportunities for the research to pick up some topics and do more and more research in these areas so that our business relations will further strengthen. So that's one opportunity we are getting from his speech. We thank Mr. Rathi for sparing his valuable time coming for this organization and his valuable input. Thank you, sir. We thank our chairman, Sri Ajay Tyagi, for coming to this event and inaugurating this event and giving us a overview of the Indian securities market. This also will give a lot of opportunities for our researchers to pick up some more topics and do research, and which will help for overall development of our securities market. So thank you, sir. Thank you for always guiding us, supporting us, and conducting such events. And I'm sure we will do a lot more research in the securities market, and will try to strengthen our research activity and overall policy making in the securities market. So thank you very much, sir. And I also thank our full-time member, Sri Mohanty sir, our director, Sri CKG Nair sir, for continuously guiding and supporting us for conducting such activity, giving us the topics for research and overall preparing the theme for this research conference. So thank you all. Thank you, sir. And I also thank you all the researchers and all the participants who have spared their time, come, presented their papers, and making this even more successful. So I wish all the best for the success of this event. Thank you very much.